Hello guys. Today I decided to do a video, not a live. Okay, we will be resume a live session on Saturday, and I will announce that. Okay, for today we try to see 5 things to consider when investing in stocks. Okay, so we just go through them, and I will tell you why they are very, very important if you want to be an investor in the future. Investing is not that big hard, okay? But you need just to work at the beginning and then to leave the stocks grow through the years, okay? So when you invest, generally when we say invest, it's more than 1 year. 5 years, 10 years, 20 years. If the companies that you select are good, why you change them? Okay, so let's go and begin with the first one. Okay, so 5 things to consider when investing. The first one, study the company. Now when we say, for example, study the company, now what does it mean? Now first you should see the earnings. Earnings, it means the profits that the company get each quarter. It means 3 months. Okay, so this is the earning for the quarter and profits compared to last year. This is how do they do that. It means, is this company making more money, yes or no? And this is in order to know the growth of this company. So this is the first thing. Now each 3 months the company announces the earnings per share, which is called EPS, earning per share. It means how much money you make if you invest $1. Okay, so you will see always they speak about, for example, let's say they make you can make $1 for $1 you invest in this company. Okay, now this is one thing which is called the earnings. Now what about dividend increase? Now understand, this is A. Now B is the dividend. Understand that we have two kind of companies. A company that give a dividend, okay, give a dividend, and there is another one that there is no dividend. So you ask yourself, no dividend with D. So you ask yourself, why is that? Now, a company that gives a dividend, it means it has been long time into the market, and it is mostly of the time it is stable, and it's always giving a dividend for a long time. Now companies that they don't give dividend, it means they leave all their money to invest in the company more and more, so they don't give a dividend. And understand that the dividend is just a cut from the price of the company. Let's say I give you 2 examples of a dividend company. Now Apple, for example, it gives a dividend. Okay, now no dividend like Facebook. Facebook is a new company. It becomes stronger and stronger, but it is still considered new, and it does not give a dividend. But Apple, it gives a dividend. So what do you mean by dividend increase? In this case, we are speaking about this company. It means you will see that, for example, this year it gives, for example, 50 cents. Okay, 50 cents as a dividend. Now you should see next year, let's say it gives 75%. 75 cents. Now here, what does it mean? It means that this company is stable, it is making more money, and it is giving more dividend. It means more increase in this dividend. It means that this company is doing good. This is just in general. Now, if you own a company that it has no dividend, it means here that this is a growth company. You will see what we call the price appreciation. It means if the stock is going after year up and up and up and up. Okay, so this is the growth companies. Now C, okay, C is competition. Competition is the most important thing in a company. What does it mean, competition, or what does I mean by it? It means that you should compare this company with another company or other companies in the same industry. Another company in the same industry. Same industry. Now, what does it mean this? It means if, for example, you choose your company you invest in, let's say it is a car, it produces cars, for example, like Honda, like Toyota, like BMW, or other kind of cars, or whatever car you like Ford or whatever. You should see if this company is having more money from the market percentage, okay, from other car companies. Let's say we make it, this is like 100. Let's say the company that I own has, let's say, 10%. Now, if this market next year, the other years, is getting 11% or 12%, it means that this company that I own is better than the other companies because it's growing faster and faster and faster. Okay, so this is the first thing you should do, is to study the earnings, dividend increase, competition. This is the most important thing you should check before you do a selection of a company. And please don't try to use what we call don't try to use analysts or other people who are in the market, okay? Because if you do that, most of the time, if they give you a reason, they don't give you other reasons. Maybe other companies are better in other reasons and they just want you to influence you to buy this company. And this is bad. So since investing is for many years, why you don't study it for 1 month or 2 or 3? You study it very well. For example, you like car producers and you want to see what is the best company in car industry. You go to those car industry companies and you study them and you see what is the best, okay, in order to select it. Now this is the first thing I can talk about. The second thing I can imagine to talk about after the first one, okay, so let's go right now. We go to the second one. Now the second one is diversity or diversify different sectors and industries. Okay, so this I want just to mention this as something very, very important. Now let's say for example, okay, you have $10,000, 10K. Let's say you want to have 4 companies, A, B, C, and D. Okay? Now, when we say diversify, what does it mean? It means try always to have different sectors. Different sectors, for example, if here you choose a bank, okay? Now, B, you use a drug company. Let's say here you use utility, okay, utility company. Now here you use mining company like gold or silver or service or whatever. Now, diversify, what does it mean? It means you should not put all your stocks that you own for a long time in one sector. This will make you a problem. Now, in order to understand what I'm saying, have you, I always talk about energy sector before. Energy sector was hit before and all the industries, they go down. So if you have $10,000 and this energy sector has lost, let's say 50%, you end up losing 50% if you put your 4 companies with $10,000 in this sector. So when we say different sector, it is just to have a balanced risk. Balanced risk. It means you will never know which one will be the best, banks or drugs or utility or mining. So it's better to get a balanced thing. So never put or invest in one company. If you invest in one company, you have the highest risk. The highest risk. If this company doesn't do good, you will be losing a lot of money. Okay? That's why you hear always people talk about diversification, diversify, and you get no clue what does it mean. Okay? And you can even, if you have a broker that has, some people, they like bonds, you can put 5% or 10% bonds, like with an interest rate. Some people, they like that. Some people, they don't like it, which is better, because the stocks, they do always good. Let's say the market is good in this year or next year or the other year. You will have high percentage of most of the stocks. Okay? But let's say the market get 25% up, but if you go to the bonds and you put 4% or 3% or 7%, you are losing a lot of money. Okay? So this is, as I told you, the second one. Now let's go to the third one, which is so important. I always, guys, I always give you the most important as I see it. Okay, in my own experience, this is what I always check and see. And number 3 is save more money and add to your investment automatically as a habit. Now this, most of the people who are saving money and they can have a big accounts, it's just because of this. Saving money should be a good habit, something that you do automatically, and you should never think about it. It means, just an example. Let's say your salary is $2,000 or $5,000 or $10,000. It doesn't matter how much money you make. The most important thing is you should cut some money from your paycheck, okay? Let's say in your bank, and let's say you put it all in a saving. Just an example, okay? And this is automatic. Whenever you get the money here into your account, which is your checking account, and now it is very easy. Okay, you have, for example, a bank. When you have a checking account, for example, and you have a saving account. Now, whenever the paycheck enters to your checking account, you just cut some money here. Now, how much you put depends on you. But in order to be in the first guys, it should be 10%. This is the golden rule. The golden rule. If you can that, the golden rule, okay? The golden rule is to have 10%. Now, if you can have more, this will be more excellent. But if you can't make it 10%, you can make it 5% or 6 or 7 or 8. But understand that whether you make $2,000, for those people who spend too much, either you have 2,000 or you have 5,000 or you have 10,000, these people, they spend all what they see in their checking account. And this is too bad. They even use a credit card, and then they spend more. They spend more what they earn. Okay, and this is a very bad habit. Now, there is another thing I can tell you, is that you can, for example, from your checking account, okay, here is your checking account. Let's say from the money that you have, you can send directly to your broker, and this is better. It means, let's say checking account, let's say you have your paycheck is $2,500 and you want to take 10%, which is $250. So you send $250 to your broker with the direct transfer that the broker has. I think it's called ACH. Okay, this is the direct from your broker. You withdraw $250 from your account, and this you do it automatically. It means whenever you get a paycheck, you send the money. Now, when it goes to your broker, you can just leave it for 2 months or 3 months until you have, let's say, 700 or 1,000, and then you can buy shares that you want. So we will deal with this later. So this is the number 3, and believe it or not, I have seen it in all my life. When you save even $20, $50, $80, whatever money you save, first you don't see the money, because whenever you see the money, you want to spend. This is our nature, okay? You see $200 or $300, and you think that tomorrow or next day there is a paycheck coming, so you say it's $200 or $300. It is, I should spend it. Why should I leave it for the next thing? Because I will get the next paycheck. And this is something bad. Most of the people who are broke, they have no idea about saving as a habit. They don't save. Whatever they give them, even if they have a salary, they have a very good hourly rate, they are making more money. But believe me, those people, since they don't save, they have no habit, they will spend it all. And this is something too bad. In order to look for freedom in your finance or in your future, you should think about saving try not to think about gambling. You spend some money and you think you will get a lot if you get a chance to win. So you begin following this dream all your life, and most of the people, they will see no money in their life. So all their money they spend, it's gone. But in real life, when you most of the people, when they save, you will see the money. So this is the third one. Now I will talk right now about something that most of the people, okay, most of the people, they don't know about it. I have spoken about it many times, but I don't know if people, they still understand what I am saying. So the other thing is number 4. Let's go to number 4. Is never use a bank, use a broker instead. So you ask me, for example, why I don't use a bank? Why a bank? It is not a vehicle for investment. Why is that? I will tell you why. Okay? So let's say you send from your bank, from your paycheck, you send $100 to your investment. Let's say it is a stock here. Now, you as a person, you think that 100 has already gone to your stock here. Let's say here you have $5,000. And when you send $100, you think it is $5,100 here. But the problem is that the bank uses a lot of fees. They create fees that doesn't exist. It creates fees. Now these fees, they say to you, for example, $10 is a transaction fee, $5 is a management fee, $2 is, I don't know what is it. So they create a list of fees from themselves, and these fees, let's say, just an example, okay? Let's say these fees becomes $30. Now, before this $100 goes to here, to your investment, minus 30, and then you find that the only thing that it goes here is only 70. It goes here to your investment. Where is the 30? It is gone because of the bank fees. I have, if you don't believe me, if you are using any kind of bank, I'm not giving you a bank name or a broker name that it is like a bank. But if you are into a plan, it means you don't do the things by yourself. So I'm just giving you this, and you can check in the future in your thing and see. Okay, let's say there is what we call an investment plan, whatever its name, investment plan. Investment plan. Whatever investment plan, they have fees. Now here, when I'm talking about investment plan, I am not talking about 401k, because it is another thing. I will explain to you about this, because here I am not speaking about 401k because it is something else that when I speak, because in 401k there is no stocks to choose from. So I am not speaking about 401k, okay? So 401k is another investment plan. But there are some investment plans that the banks offer when you have a checking account with them, and they ask you, okay, are you interested to do an investment in the future, and you will make money and in stock market? And you say yes, and then they say, okay, we open an account for you, and the money goes to your account, and the account is growing, and then you do an investment. So whatever investment plan you are doing, please go and check all the fees that they take from your money before it goes to your investment. This thing I just showed you, you can go there and go to the bank, have the numbers ready in your paper, and ask them, okay, I sent $100 for my investment. What are your fees? Because most of the time, okay, understand that banks, they don't disclose very easily their fees. They want just to overwhelm you by these ideas of investment, making money grow, and the other stuff, and you become in a dream. But later, when you check directly what's these things, fees that are there, then you discover that you get ripped off. And you know, if you want to stop, you take your money, whatever. But some people, they stay many years, 10 years, 20 years, 30 years, and these banks are sucking their blood like this, which is, you know, this is business. You should ask, because it is, any business, it is an agreement between you and the bank. You sign papers, and you don't know what is the thing that you sign on. Okay? You sign papers, but you don't know maybe the fees. You don't know them. But you have already signed that you have read, and you know the fees. This is the problem. Okay? So check those things. If you have an investment plan, check those things. Now, here I'm not talking about 401k. 401k, they don't have stocks to choose from. So it is another investment, and I thought I have made more videos about it. Okay? So this is just to make you aware of this. Now, number 4, and then we can go to the last thing, which is number 5. Let's go to number 5. Okay, number 5. Let's go there. Okay, number 5. Check your companies in relation to their industry and major indexes like Dow Jones or S&P 500. Now, why I tell you to check these things? Now, industry, okay? Industry, it is where your company belongs to in terms of business. Okay? So, let's say the industry is going good, like this. Okay? As you see the chart. The chart of the industry is like this. You see that it is going, it's going so good. Let's change the color with the green. Let's say your industry is like this. This is the industry trend. It's excellent trend. Almost all the stocks in this industry are going up. Now your company, by the way, you see your company, it was going good, and then now it's going bad. This is your chart of your stock. This is your stock, your investment. So, here you should ask questions. Why the other stocks are going so good and my investment is going so bad? It was going good, but it goes down. So it means there is a problem in your company. There is something wrong. You should check and you should dig. Why is that? Okay? Now, if your company, at the opposite, if your company is doing better than the index, it means that your company is what we call a leader. A leader, it is a stock that leads the whole index. It means it is better than the index itself. And this is the stocks that I always work with. I like this kind of stocks. Stocks that are better than the industry. Now, you can also compare your company with Dow Jones or S&P 500. Because why is that? Why all the people, they always they speak about Dow Jones and S&P 500? Because it gives you in real a general idea about the 30 biggest stocks in America that are diversified. Because understand that when you go to Dow Jones, these 30 stocks, you find different sectors. It means they represent the whole stock market. S&P 500 also, it represents 500 of the mid cap. It means the most big company, mid capitalization. Okay, so these are big companies, 500 that are the biggest companies in the USA, and how do they grow is very, very important. But most of the time, Dow Jones and S&P 500, they always have the same chart. They don't go that far, but they're always the same. Now, you should, for example, try always to compare. Okay? Now, let's say now, like this, and like this. This is now how the Dow Jones and S&P 500 are doing. Now, let's say your company is doing the same as 500, as Dow Jones, but it's still going up like this. Now, what does it mean? It means that this is your company, it is better than the Dow Jones and the S&P 500. So because S&P 500 and Dow Jones are here, but you are here. So you see that your company is good. But what if your company stops here and is going down like this? It means that your company has problems, and you should check what is these problems. Why your company is going so bad in terms of price? And it is not even with the Dow Jones or S&P 500, because if you buy the ETF of Dow Jones or S&P 500, it would be better for you because they are doing better than your company. So we like companies that are like this, are better than the general market. This is what we like. Okay, so these are the 5 things that I can remember, and they are very, very important when you are investing for the long run. Understand that you should be patient. It's not like a day trading or swing trading. You buy this month and you sell the next month. You will never know how the company grow if you don't give time. Because why we have investing? We have investing is to give good companies a way to show us that these companies can grow and become bigger and bigger and bigger. You should give it time. 1 month or 2 or 3, it will never give you a real growth. Okay? Because if you are doing swing trading, you stay a few days or few weeks or few months or 6 months or 8 months, this doesn't show you the potential of this company. This company, if it stays 5 years or 6 years, it can go from $20, it can go to $300, for example. So it might have a very, very good growth, not this year, not next year, but the other year. So you should wait for this company if they are excellent and they are good. Okay? So this is the 5 things I want to say. Please, if you have more important thing in investing, please let me know and comment in this video, or send me an email if you like, and I will write you back. Thank you very much, and see you next video.